Hello, hello, and welcome back to zinstake, your favorite new news podcast made for the everyday person to try to decipher what in the world is going on around us. Do we know exactly what's going on here at zinstake? No, but we do our best. Now, to start with a disclaimer, anything you hear on this podcast, people, is not financial advice. I'm just a guy on the internet. I'm not your financial advisor. Find one if you need one. Okay. And also, if you ever hear anything that you feel, gets your blood rising or something that offends you, just turn it off. Please don't listen if it upsets you. This, might not be for everyone. And we know that here at zinstake. So, starting with the first news article of the day, it is China's refined copper imports remain surprisingly strong by Reuters. China is pivotal for copper markets due to its status as the largest buyer. Despite negative signals, China's imports of refined copper have been strong, with a 19.2% increase year on year in the first 5 months of 2024. Changes in China's copper trading behavior, such as increased exports and stockpiling, have ripple effects across the globe, influencing international market dynamics. Investors in copper commodities face risks due to China's unpredictable demand and potential market slowdowns. High volatility can lead to unpredictable returns. The state stockpiler is looking to buy up 15,000 tons of cobalt in expectation that prices will rise. Why not copper? Given much of the world expects copper prices to hit new super cycle highs over the coming years. So this is just a news story onto our ongoing narrative about what in the world is going on with copper and this super cycle that may or may not happen. Here at zinstake we believe in the super cycle. And it just goes to show you that even though there is China slowdowns after the big deflationary hit that they took, what was it, last year now, they're still buying up more copper than they used to. Everyone's buying up more copper than they used to. We talk about it all the time, right? There's that area between Istanbul all the way to Jakarta where people have rising GDP, rising wages, and more money to spend, which means they're going to buy more things, and almost every single thing that's electronic has copper in it at some level. And that's another thing too. Even if China does slow down, China makes a lot of copper, they import a lot of copper, they make a lot of refined copper materials for people all over the world. If India starts buying, Indonesia, who knows? Millions of people, billions of people actually, all over the world are improving their life standards, higher life standards, which mean more and more copper, right? But moving on, this is everyone's favorite energy, uranium. Kazakhstan's surprise tax increases shakeup to global uranium market. This is from oilprice.com. Kazakhstan has introduced a new mineral extraction tax for uranium, increasing significantly from 2026 onwards. The new mineral extraction tax, uh, the structure of it replaces the 6% flat rate that the MET introduced in 2023. The new MET rates are expected to discourage uranium production growth in Kazakhstan. Reduced supply incentive and increased uncertainty could drive uranium prices higher. Notable stock increases: Next Gen Energy plus 6.8%, Denizen Mines plus 6.8%, and Cameco 6.6%. Higher uranium prices could lead to increased costs for industries reliant on uranium, including nuclear energy. Investors in uranium commodities could see increased returns due to higher uranium prices. The potential reduction in uranium production, the potential reduction in uranium production in Kazakhstan, the world's largest producer, could tighten global supply. A tighter supply could further drive uranium prices, benefiting investors, but potentially leading to higher costs for end users. So this is something we're always talking about. Over the last, what, 20 years, we we as a global community did not focus on uranium. We gave up on it after Fukushima, and now we're just reaping those rewards, right? As uranium mines, uranium mining in general becomes underdeveloped, underinvested in, then you have something small like Kazakhstan raising taxes. It's important because Kazakhstan is the number one uranium producer, right? Over half the world uses Kazakhstan's uranium, and half the world's building uranium producing energy sites right now. It happens every single day, and it's going to keep happening. And even though they're making more and more uranium plants out there, they're not making more and more new mines. It takes time. You got to explore for it. You got to start investing into it. You got to start mining it. It takes years. And the ones that we already have, those stock prices are going higher and higher. And here's another thing. We talk about it all the time here at zinstake. A lot of these companies, they have really great PE ratios. They're significantly underinvested in as it is, and they're really small companies as as you compare them to larger companies, say on the S&P 500 or something like that. That's why you're seeing the TSX and TSX Venture Exchange especially start going up higher and higher over time, right? Will this continue? We do believe this here at Zin's Take. Welcome to the super cycle. Next article, this is about silver. Silver. Will strong demand, tight supply keep prices shining? Investing.com. Silver prices have risen due to a consistent gap between supply and demand, with 2024 marking the fifth consecutive year of a silver shortage. In 2023, silver demand outstripped supply by over 142 million ounces. This shortfall is expected to nearly double to 265 million ounces by the end of 2024. It's only 1 year, people. Prolonged high interest rates can dampen silver prices by making non-yielding assets like silver less attractive. Conversely, a rate cut by the U.S. Federal Reserve could boost silver prices by lowering the opportunity cost of holding silver. On the technical side, silver recently broke out of a bullish pennant pattern on the daily chart, leading to a rally to around $31.50 USD before entering a consolidation period. Another bullish pennant is forming, indicating potential for further price increases. So, when it comes to silver, right, there's those two things we're always talking about. Number one, silver is a lot less political than gold. People use it as a reserve currency, especially central banks. That's for gold. Silver, on the other hand, is an industrial metal. It's not as political, they don't mess with it as much, and it also means that they use it more. And no one thinks about silver. You look at this giant gap, like it was 142 million ounces. That's the that's the shortage they have, and it's going to almost double to 265 million ounces, and that's in the short range of 1 year, right? A lot of people believe in the silver super cycle. A lot of people. Even just in the last few years, what like my little silver coins have been popping off 5, $10. It's wild. It's absolutely wild. Now, I do believe, we do believe here at Zin's Take that silver itself will bring you higher returns overall than gold. And another thing about gold is gold moves glacially slow, right? It takes 10 years for gold to make one huge move, and then it sits around for another 10 years consolidating. Silver ain't like that. Like I said, it's not political. So that means whatever happens, happens. It's an industrial metal. If people need it, prices go up. If people don't need it, prices go down. It's that simple. And right now, prices are going up. It's like we're always saying, there's a huge underinvestment. People would rather spend all their money investing in tech and data centers than investing in mining the minerals for that tech and data centers. Moving on, we're going to get to gold here. And right here, the Wall Street experts expect nearly unanimous gold posting gains next week. Main Street sentiment firmly bullish. This is from Kitco News. Wall Street, 92% of the participating analysts expect gold prices to rise, with only 8% predicting a decline and none expecting neutral movement. Main Street, 67% of retail investors are bullish, 18% are bearish, and 15% anticipate neutral price movement. Factors: lower U.S. interest rates and a weaker dollar, dovish Federal Reserve stance, and central banks in Asia and Europe increasing gold reserves. Positive sentiment and bullish outlooks suggest potential gains for those holding or investing in gold. Gold prices often react to economic indicators such as interest rates, inflation data, and central bank activities, impacting investor strategies. Gold is traditionally seen as a hedge against inflation. So, like we're saying, it's highly, highly political. People look at it as an alternative currency to fiat paper currency, right? Which means that governments care. Central banks buy it means governments care. And if governments and central banks are the ones that own the most of the gold in the world, that means they're the ones who are more than likely able to control gold prices. If they're the ones buying it, then they're the ones who want to make sure it doesn't pop off. They're not, a lot of these central banks, they don't care if the price goes up, you know, 10 times or something. It's not for them. What it is for them is to be able to use it as an alternative currency that doesn't lose value. Also, they want to stay away from, US dollars if they can. Not everybody, but some people, right? And we're going to see it. I do believe that within the next 10 years, gold will supercycle as well. All the metals will supercycle. You see the gold mining stocks all the time, they never go anywhere. Gold mining companies, they never go anywhere. It takes forever for them to mine anything. And more to the point, not only have gold and all metals actually, the mines for these places, they've become less rich over time. So what does that mean? That means that they used to produce, say, 1% or 2% gold for 1 ton. Now it's about half a percent, right? Also, the life of these mines are getting shorter and shorter because time goes by, they don't develop new mines, things take longer. This is just the world we live in. And we're all crashing up against this commodity super cycle. And now you're starting to hear in the news that term super cycle is starting to come out, right? For you super cyclists out there, 5 years ago, people called you crazy. Now you're in the news. You're not in the front page, but you're in the news. And pretty soon, with the next 5 years, you know you're going to be in the front page. So keep that faith, keep it believing, people. Okay, moving on to some oil news here. Nigeria cuts deals with producers to supply oil to refiners at market price. This is from oilprice.com. Nigeria has successfully negotiated a deal with oil producers to supply crude oil to domestic refineries at prevailing market prices. Primary aim of this agreement is to stabilize domestic fuel supply and reduce the nation's dependence on imported refined products. This move is seen as a significant step towards enhancing Nigeria's energy security. By securing a consistent supply of crude oil for local refineries, the agreement is expected to stabilize the fuel market within Nigeria. This is crucial for maintaining steady fuel prices and ensuring availability. The deal is anticipated to support and possibly expand the capacity of Nigeria's local refineries. Improved refinery operations can lead to greater self-sufficiency in fuel production. Enhancing local refining capabilities can have a positive economic impact by creating jobs, reducing foreign exchange spent on fuel imports, and potentially lowering fuel costs for consumers. This agreement aligns with Nigeria's broader strategy to maximize the utilization of its oil resources, promote energy security, and strengthen its economy through improved management of its natural resources. So this keeps happening more and more over time. Poor third world countries get more and more money, they get richer, their GDP improves, and slowly but surely their living standards improve. And of course, a lot of them have rich natural resources, including oil. And what do? They start building things like refineries in their own country, in creating jobs in their own country, which does nothing but allow them to increase their standard of living. And like we're saying, the higher the standard of living goes up all over the world, especially in the third world, you're gonna and they can increase very quickly, right? So for Western countries or developed countries or G7 countries to increase their standard of living, it doesn't go up very quick. It doesn't go up very high, right? Because they're already high. So it goes up marginally. With a country like Nigeria, it can just fly, right? Because they can go from, level 2 to level 5, level 8 really quickly, right? And if level 8 to 10 is, where the Western world lives, then they can very quickly get up there with just a small jump, right? They could do it very quickly and very easily. And they're going to do it. They want to live like we do, and there's nothing wrong with that. And as that happens, they're going to realize, we're all going to realize that the global population increases every year, at least for now. And on top of that, demand increases all the time, right? I mean, I forget the exact number, but I believe it's something like 13% of the world, which is, the G7 countries, the Western world. They use something like 60% of the world's energy resources, something like 50% of the world's commodity resources. That's 13%. What happens when the other 87%, they start rising up in living standard too? The amount of commodities needed for all these people is just not there. And pretty soon they're going to want what you have. That means computers, possibly electric cars, phones, you name it. And they're going to want the newest stuff, which has the most amount of metals, the most amount of complex minerals in it. And that's just going to mean more and more mining that they're not doing right now. We talk about it all the time: mining, oil, all these things. They're all underinvested in. A lot of the companies would rather do things like buybacks as opposed to making new facilities. And why shouldn't they? Right? They're finally, it's time for these companies to reap the rewards of waiting for so long. We don't invest in them. Most people don't anyway. And the people that do now, trust me, you guys are going to have a lot to say in the next 5 to 15 years. And you know it, and we all know it here at zinstake. Okay, moving on. We're moving on to some OPEC news here. OPEC plus cuts, OPEC plus cuts and demand woes keep oil price in narrow trading ranges from oilprice.com. OPEC plus has implemented production cuts to manage the global oil supply and support oil prices. These cuts are part of a strategy to counteract the excess supply and maintain price stability in the market. There are persistent concerns about the global demand for oil, influenced by factors such as economic slowdowns, increased energy efficiency, and the shift towards renewable energy sources. These demand side issues contribute to the uncertainty in the oil market. Due to the combination of supply cuts and demand concerns, oil prices have remained within a narrow trading range. This indicates a balanced yet cautious market environment where traders are hesitant to push prices significantly higher or lower. The production cuts by OPEC Plus and the global demand uncertainties reflect broader changes in the oil market. Stable oil prices within a narrow range can help reduce market volatility and provide a more predictable environment for both producers and consumers. However, prolonged demand concerns might necessitate further adjustments by OPEC Plus to sustain market equilibrium. So you'll notice the news will tell you that OPEC Plus does production cuts because they're afraid of demand. They're afraid that there's a global economic slowdown. They're afraid that green energy is going to be overtaking demand, right? Um, is it? Maybe. But more to the point, another question that a lot of people on TV, on the news, all over the world really, they ask themselves, is OPEC Plus doing these production cuts in order to keep prices level or maybe even increase them? Or are they doing them because they just don't have the kind of oil that they have? Some of these mines are up to 100 years old, people, right? Can they really keep mining the same 60, 80, 100-year-old mine over and over again and keep producing the same amount of oil? Questionable at best. questionable at best. There's a great book that I recommend if you're into this. It's called Twilight of the Desert, right? It's all about whether or not these OPEC countries, especially Saudi Arabia and the Arab Gulf states, do they have as much oil as they say they do? And if they didn't, they wouldn't tell you that. Instead, they would just slowly cut the production, which means that couple things. Number one, that means that there's not that much oil coming onto the markets. And like we're saying, just because the news tells you that demand is going down doesn't mean that's necessarily the case. And even if it is, how long is that going to last? How long is demand really going to slow down? Because you have the entire rest of the world, right? I'm talking about the third world here, who they're all going to buy cars at some point. They're all going to be using energy for at some level for something. It's going to happen. And over time, we here at zinstake, don't quote me on it, but we do predict that oil prices will slowly but surely rise. Now, it doesn't feel that way if you've been in the oil market the last week with prices going down sharply on you. I know the emotions surrounding that, but you got to think more long term. I know this is a 1 week thing or a 2 week thing. In real life, you got to look over the years, right? And right now, oil's been ranging, year to year between 60 to 90, sometimes $100. How, but somehow inflation's gone up. Somehow everything else has gone up prices wise. Your grocery bill's gone up, your TV, your car, everything has gone up except oil. Is there more oil in the world? A little, but not much. And there's still significant underinvestment. There's still significant underexploration and everything else. And as the world continues to do that little climb they do towards higher living standards, you're going to see more and more oil. I'm sorry, people, but oil is the lifeblood of the global economy. If you're green, I'm sorry, please cover your ears, but that's the truth of it, right? And the world, yes, maybe 1 to 5% of people in certain G7 countries might be using electric cars and this and that, the other thing. And of course, let's just forget about the rubber and the roads and everything else that uses oil that you use. Forgetting about that, that still means 99 to 95% of people in the G7 countries still use combustion cars. And it's going to be like 99 to 100% in most third world countries, almost every single one of them, which means that as the world turns, they're going to use more and more oil. It might not happen all at once, people. Okay, you might have to wait a little bit. But if you're in it for the long game, believe in the super cycle, people. It's going to happen. All right, moving on. Enough about oil. This is some fun news for you here. Institutions snapping up Chinese treasury bonds are shorting the economy of China. Reuters. So this is from Reuters. Institutions are buying large amounts of Chinese treasury bonds, which are considered safe investments, signaling their lack of confidence in the broader economy. By doing so, they're seeking stability and economic uncertainty. At the same time, these institutions are shorting other economic sectors, betting that their values will decline. This dual strategy indicates they expect economic troubles ahead. The heavy investment in bonds and shorting other assets can drain capital from more productive uses in the economy. The Chinese government views these actions as harmful to the economy and indicative of negative sentiment among major investors. I don't know what the Chinese government really expects around here, You start coming into the capitalist world and you start wondering why people are acting like capitalists. Who knows, right? We talk about this all the time. China has issues. We're not going to dive too deep into those issues, but you do see it. And people are worried. They had a deflationary crisis a little while ago. You know, here in the Western world, we like to think that housing prices go up forever, while in China they didn't. And I say this all the time to my friends and family. If it can happen in China, it can happen to you. Now, China is more of a command economy, right? But their financial markets are still financial markets, and people don't trust it anymore. You got institutions shorting everything all over the Chinese economy and buying up treasury bonds to keep safe their cash investments. That's pretty much all that's going on over in China. Now, don't be afraid. Yes, China is the workhorse of the world, but you have to remember, even though China is the number two economy right now, with their population crisis the way it is, I don't see them becoming the world's number one economy anytime soon, especially not before people like India, right? And like within the next 20, 30 years, their age, their like average age is going to go from believe it's 40 or 50 right now to about 60 or 80, just like in Japan. They're going to turn into another Japan. They're not going to be popping off to the moon anytime soon. And more to the point, there are whole economies that when you put them together, your Indonesias, your Malaysias, your countries like Turkey, all these smaller minor countries, the stand countries of Central Asia, when you put all them together, they're like their own China. And they're all advancing and their economies are all booming, at least slowly. All their populations are booming. It's all happening, especially the big player in that game, India. So just because China goes down, it doesn't mean the rest of the world won't go up. Now, would I be investing in China right now? Probably not. They don't look like a good bet, especially if institutions are betting against them heavily. Possibly their own institutions. I mean, it just tells you what's going on over there. People there just don't believe in their own economy anymore. And slowly but surely, I feel that the downfall of China will come sooner rather than later. And by sooner, I mean like within the next 10 to 20 years, not the next 10 to 20 months. But you never know. Moving on, mounting sovereign debt shows no sign of moderation. This is from the S&P Global News. Sovereign debt has been rising since the global financial crisis, 2008 to 2011, further accelerated by the COVID-19 pandemic and geopolitical events like Russia's invasion of Ukraine. Deep interest rates are low during these periods, making borrowing costs negligible for many large economies. Despite the recovery of GDP growth from the pandemic era, G7 nations are not returning to pre-pandemic debt to GDP ratios. Governments have shown little interest in reducing borrowing, even as global conditions normalize and interest rates increase. Large advanced economies continue to enjoy relatively cheap borrowing costs due to their ability to finance through reserve currencies and large pools of domestic savings. Emerging economies face higher borrowing costs due to the lack of a robust track record and the inability to borrow in their own currency. So you see it already. G7 nations are just taking advantage of their positions. They're not reducing debt anytime soon. They are enjoying cheap borrowing costs still, even though they have huge sovereign debts. And you see it, and that's the thing. What happens when the debts continue to rise higher and higher and higher? Your interest rates are still relatively low. I mean, we're talking single digit low numbers here, guys and girls. I know that it seems high to a lot of people, 5%, 4%, 6% policy interest rate. Emotionally, it feels like a lot because, especially for the younger audience here, you grew up in an era of extremely low interest rates. So that's mentally normal to you, right? You don't think that because of those extremely low interest rates and government overspending, you've had crazy high debts, especially after the pandemic. Then you have even higher debts because your governments are trying to save their economies while not having their economies working. And the problem just compounds. And instead of, reducing their debt, raising their interest rates, and doing all the right things to balance their budgets and economies, instead, they just keep the ship moving. They just keep it going. And does that mean the ship will crash? Maybe not necessarily, but you do see growth rates slowing down. They just can't keep it the way it used to be. There's a point where you just can't keep that speed of economic growth at that level anymore. And sometimes you can bust right down. Ask China. This is what happens when you borrow too much money and you overspend and you do all these things. And then your inflation rises up and your consumer spending goes down. Your governments might not think about it and you only vote for them once a year, very passively, of course. I don't blame the average person. I understand that politics is hard, it's confusing, it's designed to be confusing. Watching the news can take time out of your day. This is why we have podcasts like this. I understand it's not easy to pick someone. And even still, when you do pick someone, especially for younger people out there, who do you pick? Nobody seems to be having your side. Nobody talks about reducing debt. Nobody talks about increasing interest rates, fighting inflation, all these things. All they talk about is using government money to get you more stuff. And where does that government money come from? The taxpayers. And instead of reducing those things, we're all used to it now. So the governments just keep rolling on. They just keep rolling on. They just keep buying new things, overspending and using loans, their own bonds in order to fund these problems. This is real life, people. You're living in it. I know this isn't what we want, but this is the world we live in, and we should just be grateful that we're all alive. Some of us are living some decent lives. Yes, grocery prices are high in G7 countries, but at least you can still somewhat afford them. Things are hard right now, and there is going to be change around the corner, but it's going to come at a very slow rate. They're not talking about reducing these debts anytime soon. All right, that's enough negativity for the day. Let's move on to what's going on in the Red Sea. Shipping winners and losers from an end to the Red Sea shipping crisis. Splash247.com. Analysts predict the Red Sea shipping crisis could continue into the first half of next year. Many merchant ships are avoiding the Red Sea and the Suez Canal, opting for longer routes around South Africa. The Clark Sea Index indicates profitable times for shipping segments due to the crisis. Uncertainty and potential resolution to the shipping crisis can lead to volatile shipping costs, affecting consumer prices for goods transported via these routes. Investors in shipping and related commodities face risks from market fluctuations due to political instability and potential ceasefire impacts. So, there could be ceasefires. The Houthi Red Sea crisis debacle could end, but it's not ending right now. And more to the point, what happens in the long term? Shipping is another sector of the economy that is underinvested in. Those shipping boats, those giant tankers, they get older every year, and they get more expensive every year because of all the things we're talking about. Everything from inflation to commodities supercycle, you name it. They make these things more expensive. It's harder and harder for them to buy new ships, and they're heavily underinvested in. That just makes shipping prices and costs go up, right? And over time, as they go up, they're going to make more money, which means that people might slowly but surely invest in these companies. Will they right away? Nothing ever happens right away, right? People are always going to invest in tech first. Or whatever the new shiny object is, whatever it happens to be. But right now, that's tech. Things like shipping and mining just go right over people's heads. They don't even think about it. They don't care about it. Makes them feel bad, especially the green folks out there. Again, please, if you're green and this stuff makes you emotional, cover your ears. I know it's hard for you. Okay, I'm not here to offend you. But more to the point, let's just sticking back to this Red Sea crisis. This, in and of itself, is inflationary. So not only do you have governments around the world, especially G7 countries, increasing their debt to GDP ratio higher and higher, getting more and more treasury bonds out there, printing more and more money to pay for those things, increasing your inflation, but also you have things like this happening as well. And we here at zinstake, we do believe that inflation creates more inflation. So when you have actual real monetary inflation, what does that do? That makes people's lives harder, especially all over the world, especially in poor third world countries like the Yemen. They're suffering from a big war right now, right? And then what happens? They overreact. They start causing wars all over the world. You see it everywhere, everywhere from Burma, Libya, Yemen, Ukraine, you name it. There's wars everywhere. Whether or not that's caused by inflation isn't the point. The point is, every time you see it, inflation happens, then war happens, and then those wars cause more inflation. That's just that's just a fact of life. And it's the same thing with this that you get with interest rate cuts, right? Everyone wants it so bad, so you hear it in the news all the time, at least for the next few months, We here at zinstake, we don't see it slowing down anytime soon. Not the Red Sea crisis and not inflation. At least that's zinstake for you. Okay, moving on. For the last article of the day, let's get to everyone's favorite war, Ukraine. So again, I want people to know that these wars, they're not fun. People do die. It's very sad. And while we do our very best to try to benefit from what's going on, never forget that there are real people in these places and real people's lives really do suffer. Okay. That being said, moving on. This is from the Kiev Independent. As Russia's war wages, Ukraine struggles to renegotiate $20 billion debt deal amid looming deadline. Ukraine's debt has grown sharply due to the ongoing war with Russia, totaling 151 billion as of May 31st, 2024. IMF supports Ukraine's restructuring proposal as part of a $15.6 billion aid package. This is all in USD. Ukraine faces an August 1st deadline to restructure approximately 23 billion in foreign debt to avoid default. Two potential outcomes. There's successful restructuring, reduced debt and extended repayment timelines. Extension of the freeze provides more time for negotiation but delays resolution. Countries providing aid to Ukraine may face increased financial strain. Bondholders face potential losses if a significant debt reduction is agreed upon, and prolonged debt issues in Ukraine can contribute to global economic instability. Ain't that the truth? So, one of the things here is that countries providing aid to Ukraine face increased financial strain. So, you know, while a lot of us do support the war in Ukraine, you got to understand that there are people out there, they see prices going. They know that the government overspends. They know that the government's in debt. Everyone, almost everybody around the world knows that. In their own country, wherever it happens to be, whether you live in the UK, Germany, the US, Canada, whatever it happens to be. Then what happens is you watch on the news that egg prices have doubled, grocery prices have gone up 20% in the last few months, all this stuff. Then you see that your government sends money to Ukraine and they're going through financial strain, you're going through financial strain, but somehow Ukraine's the one that gets the help, not you. That's what upsets people, right? So when you wonder why people have a problem with the Ukraine war and why they don't want to have their countries involved in it. That's why. It's real easy when you're going through an economic boom and everyone's wages are increasing and prices are going down and they're getting cheaper, especially in this new world of technology, which technology in and of itself should be deflationary to your environment. The simple example I have here is when I was growing up, and like what, 10, 15 years ago now, 20 years ago, your parents had to buy cable. Cable, if you wanted all the fancy channels with all the shows, cost $150 a month. No problem. Now you pay $10 subscription package or say $50 in all these different subscription packages and you got all the shows, whether it's Disney Plus, Netflix, whatever. You get all the shows and there's no ads and you just go right through them. And that in and of itself is deflationary, right? So to think that in this new world of technological advancement and innovation, you personally are suffering through inflation. Well, it's that old Milton Friedman quote where it says that there's only one entity that controls the monetary, that controls the money, which means that there's only one entity that can cause inflation, and that's the government or the central bank, whichever you prefer. That's just a fact of life, right? And you're seeing it all the time. These things are tough for people, and Ukraine is having serious debt issues, and they're having serious issues all while you have governments all over the world, at least the Western world, propping them up, trying to get them to win this war. They're not. I'm sorry to all you fans of the Ukraine out there. They're slowly getting attrited. I look at the map all the time. And that's another thing too, right? When people ask why don't people support the war in Ukraine more, like I said, you're going into debt, your government's going into debt, prices are going up, nobody's helping you, and everyone seems to be helping Ukraine, at least on the news, right? At least on the news. That's not why inflation happens, right? But when you see it, it hurts. Not me, but other people. And then when you see it, you think to yourself, not only are they helping the Ukraine, sending our tax dollars to the Ukraine that they don't even really have. They're doing all this and Ukraine is slowly losing. That's tough on people. That's emotionally and mentally tough on people. And on top of that, they got this huge debt issue that they got to deal with the IMF as well. And we'll see how that goes. We'll see if they sort that out. But in the meantime, the world does look like it's in a dire state. And if the Ukraine falls or some crazy economic catastrophe occurs, I'm not a betting man, but if I was, I would tell you things could very quickly hit the fan. So we'll see. We'll see. But anyway, that's the show for everyone this week. I hope you enjoyed it. And if you did enjoy it and you liked it and you like what you heard, please, remember to like, share, subscribe. We have Patreon and the coffee thing where you can just give us a buck if you want to. You don't have to. But if you like what you heard, like, share, subscribe, tell a friend. Just tell someone. Don't be shy. It's okay. And this week's shout out goes to our good friend Keaton. I hope that you enjoyed what you listened to, and I hope that it was helpful to you. And goodbye and good day. And we all hope you have a lovely day here at zinstake. Please enjoy your afternoon. It's summer. It's nice. Bye now.